All right, let's get right into it. The analysis report we're looking at is titled Real Estate Comeback: Why Open is My Top Pick for the New Year.
A strong title.
It is. And the core argument, as I see it, is that Opendoor's AI transformation, plus its nationwide expansion plan, makes it a prime pick for a real estate comeback, targeting $10.87 or higher in 2026.
A very bullish case.
It is, and, there are some real strengths here, especially around the technology. Okay, so what I really like about this material is how clear it is on the AI pivot. It's not just some vague buzzword.
No, it's specific.
It highlights these quantified gains, like cutting home assessment times from a full day down to just 10 minutes.
And the operating expenses slash over 40% year over year. I mean, those are powerful numbers.
They really are. They make the operational story feel incredibly solid.
It's laid out very well. I guess my question is, do we connect those great operational numbers directly, with actual math, to the final financial goal? The material does a great job presenting the tech pivot, but it could really strengthen that analytical bridge.
The bridge between operational efficiency and the 2026 adjusted net income target?
Exactly that. That's the missing link.
It almost feels like two separate points right now, doesn't it? We're super efficient now, and therefore we'll be profitable by 2026.
And that's a leap. That's where a sharp investor is going to start poking holes.
Right.
The weakness really is that the report treats that management goal, profitability by late 2026, almost like it's a given, like it's just an accepted outcome.
Instead of a result of the efficiency.
Precisely. It doesn't provide a detailed model of how these specific metrics translate directly into that financial milestone, especially when you factor in market volatility.
Which is the exact thing that got them in trouble before.
Yeah, operational efficiency is fantastic, but it doesn't automatically equal profitability if the scale isn't there to support it.
I see. So that 40% cost reduction is great, but we have to prove that when you apply it across the whole business, it actually moves that massive net income needle enough to hit the target.
And that's the core suggestion. Integrate those efficiency stats much more explicitly with the long-term financial structure.
How? By modeling it out.
Yes, by modeling the minimum scale or maybe the turnover rate that's required for those AI cost savings to overcome all the other business expenses and, those market risks.
That would transform the analysis, wouldn't it? From a story about operations into a proven financial thesis.
It moves the argument from hope to math.
Is that something you typically expect in a turnaround report like this? That level of modeling?
Oh, absolutely. For a turnaround story built on tech, it's essential. You have to prove the financial value.
So give me a concrete example.
Okay. You could, for instance, quantify the exact cost per transaction needed to hit that adjusted net income goal.
And then you show how that 40% expense reduction makes that number achievable.
Exactly. It shows the reader the equilibrium point. It gives them a clear threshold to watch.
I like that.
Or, here's another way. You could estimate the minimum quarterly transaction volume that this lean, mean, AI-powered machine needs to hit.
Assuming current margins, of course.
Right, and if that required volume is way lower than what they're doing now, well, your bullish case just got a whole lot stronger.
And if it's near or even above their historical peaks,
then the risk becomes crystal clear.
That kind of detail, that minimum hurdle rate for scale, would make this so much more robust. It addresses the skepticism head on.
You make the profitability goal feel earned, not just assumed.
Okay, and that need for hard comparative data actually brings us to the next point perfectly: defending against the skeptics.
The scary data section.
Yes. The report is very upfront about the Q3 revenue decline, 33%, and the current operating losses. I like that.
It is, but it dismisses them a bit too quickly, I think.
As just intentional shrinking.
Right. A strategy to survive the high interest rate crisis, which is a fine narrative. But to really maximize the report's robustness for, sophisticated investors, the analysis needs a more detailed, more quantitative mitigation of those risks.
You're saying the narrative isn't enough?
The narrative is great, but we're relying heavily on management's story here. We need to offer our own granular data points to prove the shrinking was strategic and controlled.
And not a sign of, say, a structural market failure for their model?
Exactly.
But isn't it fair to assume it was intentional? Given the 40% expense cuts we just talked about, the market seems to be buying it.
That's a fair point, but our job here is to provide evidence that stands on its own, independent of the stock price or the popular narrative.
We need proof that the machine is truly leaner now.
Yes, leaner now than it was during, say, the peak inventory periods back in 2022. We need a fitness metric that's independent of the overall housing market's revenue numbers.
A measure of internal discipline. Okay, I get it.
So, building on that, The suggestion is to ground that strategic shrinking story in specific comparative financial data.
Benchmark the current efficiency metrics against prior periods.
You got it. That validates that the company is actually a healthier, more controlled entity that's ready to scale, not just a smaller version of its old, less disciplined self.
What's the best metric for that, for proving that kind of fitness?
I'd focus on inventory holding costs. That's where the rubber meets the road for them.
Okay.
As a concrete example, you could present a comparison of their inventory holding costs as a percentage of inventory value.
From the pre-shrinking period versus now, post-shrinking.
Yes, and if that percentage has dropped dramatically, that's your quantitative proof. It's the validation of the lean, mean machine thesis.
It proves they're disciplined about how long they hold a house and how much capital they burn while doing it.
It shows deep control. That's a powerful internal benchmark. It tackles the skepticism directly by proving the retreat actually yielded tangible improvements.
Right.
And to really hit home with the more technically minded investors, you could also bolster the technical assessment.
The part about the price drop to $6.01.
Yes. The report says to interpret it as healthy market behavior, a higher low setup, which is fine, but it needs more weight.
So don't just state the conclusion, prove the pattern.
Exactly. Specifically analyze the trading volume around that drop to $6.01. Compare it to previous price spikes.
Show why it's a higher low.
Yes. Clarify why this specific dip looks like accumulation or healthy profit-taking and not just, sustained selling pressure from institutions. Show the volume cluster that's supporting that $6 level.
That adds a whole other layer of technical credibility. It goes way beyond just pointing at a chart pattern. That's very comprehensive. So we've covered proving the AI profitability model and proving the company's resilience. Now, what about the future? Let's talk about the expansion plan.
The potential contradiction.
Yeah. The analysis makes a really strong case for this nationwide expansion to effectively every zip code in the US as a huge catalyst.
It is a massive catalyst.
But I can definitely see the tension here. You're expanding your addressable market to the entire country, while you're also supposedly focused on cutting expenses and hitting profitability by 2026.
It seems contradictory on the surface.
It does. And that's really the heart of the third critique, isn't it?
It is. The massive expansion is framed as this powerful catalyst, but the analysis should clarify how that move aligns with the immediate goal of a lean, profitable model by 2026.
So why does that tension exist in the report right now? What's the weakness?
Well, without a clear explanation, expanding your footprint to cover the whole country while you're shrinking your core business, it kind of suggests a dilution of focus.
Or unexpected costs.
Exactly. Unexpected scaling costs. Think about navigating hyper-localized regulations in hundreds of new markets. The AI pivot might not solve all of that immediately.
And if your goal is immediate profitability, a massive expansion is usually a huge drain on capital and management focus before it pays off.
So the big question becomes, is this expansion a controlled AI-enabled strategy? Or is it an overly ambitious distraction that actually threatens the 2026 target?
And we need to make sure the report frames it as the former.
Absolutely. And that's the suggestion. Articulate the role of AI not just in assessment speed, but specifically as the core element that eliminates those traditional geographic barriers.
And then explain the rollout.
Yes. Explain the prioritization strategy for this massive new footprint to make sure the growth stays controlled and aligned with that 2026 profitability goal.
So the argument that AI makes expansion cheap needs more support.
It needs much deeper support. How do we show that AI fundamentally changes the unit economics of geographic expansion?
Give me an example.
Okay, for a concrete example, you should detail how the AI model is specifically designed to handle all that variable, hyper-localized market data.
You mean like regional zoning laws, county tax codes, even vetting local contractors?
All of it. If you can show the AI solves that traditional friction, you prove expansion becomes a low-cost scaling tool for them.
I see. So instead of needing a regional manager and a whole team in every state,
the AI handles the local details, letting the central team operate everywhere cheaply. That's the narrative you have to deliver explicitly.
And you mentioned the rollout. We need to show that it's controlled.
Precisely. Another great example would be to provide a projection on which type of new market they'll target first in 2026.
Okay, like are they going after low-volume, mid-tier cities where AI gives them an edge because competition is low?
Or are they still just focusing on the big metro areas where volume is high but so is the competition?
That articulation of the strategy, the who first and why, connects the expansion directly back to the financial goal. It shows disciplined growth, not just a land grab.
And the current analysis report Real estate comeback, why open is my top pick? It already has a powerful framework. Reinforcing these three areas would just make it exceptionally robust.
We've covered a lot of crucial ground here. Let's recap.
The high-level opportunities really center on three things. First, strengthening the analytical link between AI efficiency and that 2026 profitability goal.
By using specific financial modeling.
Right. Second, the need to quantitatively back up the mitigation of those bear case risks, like the 33% revenue drop.
Using independent metrics like inventory holding costs.
Exactly. And finally, clarifying the phase strategy for the nationwide expansion to show it supports, not distracts from, the immediate profitability goal.